Fed approves 0.75 basis point hike to take rates to highest since 2008. Hints at change in policy ahead. This is a CNBC story. In a well-telegraphed move, the markets have been expecting 4 weeks. The central banks raised its short-term borrowing rate to 0.75 point to a target of 3.75 to 4 points, the highest since January of 2008. The move continued the most aggressive pace of monetary policy tightening since the early 1980s. The last time inflation ran this high. The new statement hinted at the policy change, saying when determining future hikes, the Fed will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Economists are hoping this is much talked about step down in policy that could see a rate increase of 0.5 point in December meeting and then a smaller, fewer hikes in 2023. This caused the market. They announced this late, and the market tanked. It went from being down 20 points to being down 500 points within literally, I think, 30 minutes or so. So, Tom, when you see this, what are you learning with this rate hike they announced yesterday?
Well, what you have to remember is when they say when the typical person reads well telegraphed, what that meant was the banks that make the mortgages were expecting this. Because remember, the mortgages move with the bond market and the mortgage-backed securities. And what the average person needs to understand is that the interest rates affect those first, then the mortgages. So the mortgages about a week ago were sitting there like 7.375, which is 7 3/8 to 7.5 is where they were. And this morning, I went in there and I looked and I said, what are they adjusting? Because they had built in some of this 0.75 of a rate increase. But what they heard Powell say is there's probably another 0.5 point coming in December. And so that moved things this morning. And I looked it up. If you're a person, typical in the United States, we were just talking about this.
Pull it up. Type in Google mortgage rates.
Yeah, mortgage rates today, and you'll get the
and by the way, Tom, you have to realize this 0.75 basis point increase doesn't take into effect with rates for another week or so. So people are going to see an increase next week, maybe the following week.
Yeah, so go ahead. Perfect. This is it right here. Now move the credit score. Just take it down to 680, 690. At 7.891. You are knocking on 8. Now let's say I've got a little bit of credit card debt and I've had things going on during the pandemic. Just take me to 650. Not any more than that, but just right to 650. Jeez. Boom. 8.327. So the banks are drawing a line. If you are below 650 right now, which is not horrible credit.
Below 660. If you're below 660,
below 660, not horrible credit.
Yeah.
You are at 8 3/8, 375. That's where you're sitting right now, which means, this is put it in perspective. Now we're talking rates and everything. Let's put it for the typical person. You bought a house, Vinny.
Yeah.
Last March.
Yep.
Say for $500,000.
Okay.
3.5% loan. Your payment was $1,800.
Mm-hmm.
Pretty reasonable.
That's my rent now.
If you try to buy that same house right now, $500,000 house, $400,000 loan, and you go out and you get a 7.8% interest rate, it's $3,000 payment on the nose.
$1,200 more.
Which means, and if you said to your bank, but I can only afford $1,800, and they said, okay, that's fine. Just go find a house that's worth $310,000.
Oh wow!
Do you see what just happened?
Yeah.
For your same $1,800 with that interest rate.
Yeah.
So that is ladies and gentlemen, a 40% drop in buying power for the American consumer. It's real. This is not speculation. This is not Pat and Tom talking about the future. This is reality right now. So if your job is moving you to another area, people have said in the comments, well, what do I do? You know, what's in it for me? What should I do? If your job is moving you from one part of the country to the other, first of all, you're going to have to discount your price on the house you got right now. It's probably up a bit. Get out from under it, and then under-consume housing on the other end. Get yourself a lease and get small space. Make the kids share a bedroom for 1.5 years, 2 years, and that's how you're going to have to weather the storm. You don't have any choice on it. Go lease less. Don't let your pride and your
You know, it's crazy, Tom, you're saying this.
You'll be back. Yeah. You'll be back, but just surf it out.
Anytime we talk about things like this, a lot of friends and family and people that follow the content that are loyal to it, who are in the real estate and mortgage business, they message us. Listen, and here's how it all starts. Pat, I love all your content, except you've been going after us realtors for too long, man. And this is like not cool. And I'm like, look, I understand you're not happy about what we're talking about. But here's what I will tell you with the current messaging that we got going on. This is here because of printing fake money for too long. Yesterday, Tom and I were talking. I said, okay, when is the next time rates are going to be around 5%? Okay, so we're actually doing the math together. So then we pull up and we say, okay, how long is this guy going to be in the chair of Fed, Powell? Well, he got elected when? May of last year, May of this year, 2022, by Biden, because he doesn't really report to the president, but you need the president and a certain amount of people to get him to say, we want you to stay as the chair of Fed, right?
The Senate votes him in.
Yeah, the Senate and
he was
president.
there since the Trump administration.
He was. So
he was reelected.
But the point is,
reelected, not elected. Right.
He was reelected by Biden, so Biden kept him in. So this is not a Republican or a Democrat type of guy. This is a guy that both of them are like, dude, he's not listening to me. He's not listening to me.
That's how the Fed should be.
Should be. You're right. So he doesn't take counsel from Trump. He doesn't take counsel from Biden.
Independent.
We like that.
Oh,
You as the consumer, believe me, we don't have enough people like that.
Yeah.
You know when his next term's going to be up? It's going to be May of 2026,
shit.
which means the next time rates are going to be at around 5%. It's probably going to be Q3 or Q4 of 2026, if that. And this 6% above could stay for a long time, and that can become the norm. Here's the challenge. This morning I was looking up an article by Wall Street Journal. I want to send some of these pictures to you. And I don't know if you guys knew this or not, but Federal Reserve has assets and liabilities. Okay, they have both assets and liabilities
on their balance sheet.
On their balance
basically
sheet.
the fourth branch of government, if you want to think of it that
So
way.
when you say they buy their own, they're
Dude,
like their
they're
own
a
entity.
company. They're a
Jesus
company. So
Christ.
Tyler, I'm going to airdrop this to you if you can pull this
That
up.
goes down to the premise of quantitative easing, quantitative tightening. That's how they kind of limit
Yeah.
the money supply.
Adam, don't start that. My nose is going to bleed.
But
Quantitative easing.
But typically what they've done, they've stayed very neutral. It's been very neutral. So all of a sudden when they start, if you can pull this up, I don't know if you see it or not. If you got it, I want to show this. It's very insightful on how the Fed works. Pull up all three of them if you can. So go to the first one I sent. Okay, zoom in a little bit. That's the balance sheet, the other one. The balance sheet of, the balance sheet of the Fed. Here's what you're looking at. Zoom in a little bit if you can. I don't know if you can or not. So, okay, here you go. On the asset side, they have $5.61 trillion of U.S. Treasury securities.
T-bills.
T-bills, exactly, short-term bills, okay? And then they have $2.69 trillion in mortgage-backed securities.
That's the MBS I talked about.
That's right. That's what you saw in Big Short. So again, $2.69 trillion mortgage-backed securities. Is it the same way to explain, Tom, like a reinsurance, right? Like how Munich Re, a lot of these smaller insurance companies, they go to a Swiss Re and they're the reinsurance that's backing them up. So $2.6 trillion.
It's the Jenga scene from The Big Short.
Oh, yeah, I
Bad,
got you.
good
A's,
loans,
B's,
bad loans, and
triple
cat
B,
shit.
triple B.
That's right. And then they have $0.48 trillion, which means they have roughly $8.78 trillion of assets. Now liabilities. Currency in circulation, which is interesting because currency in circulation is $2.28 trillion. Okay. Reserve balance, $3.04 trillion. And other is another $3.46 trillion for a total of $8.78 trillion. Okay? Go to the next one. This is the scary part of what's happened to them. Go to the one prior to that I just showed you. Yeah, right there. So the earnings of Federal Reserve sent to U.S. Treasury for the last 12 years, okay, if you look at that, this is the first time they're in the negative. How is the Federal Reserve in the negative? Do you realize for 11 years straight, this is a very interesting fact, for 11 years straight, the Federal Reserve has netted $4 to $10 billion every month. Let me say that one more time. Every month, the Federal Reserve has netted $4 to $10 billion, except for this month. Look what happened right there. What the hell? Boom. Drop off.
And then something bad happened.
Yes. And then if you go to the other one I sent you, I don't know if you got another one or not. There was a third one I wanted to show you, which is very, very interesting when you look at this. I'm sending it to VT MacBook Pro, so it just comes straight to you. I don't know if you see it or not. If you got it.
Oh, there we go.
There you go. If you can pull that up. Check this out. So this is how it looks, okay? The green, if you look at this, the green is Treasury securities. Cool. The light green is mortgage-backed securities at the top. The dark red is currency in circulation. And the light red is bank reserve. And then white is other, right? Go prior to 2008, prior to quantitative easing. It's very normal. Not a big deal. They didn't get involved. They just kind of were in there, they didn't do nothing. They were not manipulating the market. They were not manipulating the economy. And then they say, there is this thing called quantitative easing. Let's get involved. So they got involved. Oh, shit. Okay, now we're in too deep. And in 2020, oh, shit, COVID. Oh, what do we do now? Now it's like getting off of this. This is why when people sit there and they're like, no, this is not going to happen. Real estate's not going to take it. Dude, there isn't a better definition of fake success for this many years. And Powell, who right now has got a very, very hard job, because anybody that's hated by Republicans and Democrats is probably the most honest man in America, okay? This guy is not liked by anybody.
Yeah.
No one likes this guy. The left doesn't like him. The right doesn't like him. Heck, the people in the middle are confused. They don't know if they like this guy or not.
Yeah.
But all he's saying is, guys, we can't go like this for too long.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.